we were going to talk about the RSI today. What is the RSI? How does it work? And why is it so significant for traders?
RSI is one of the most important indicators. We call it as, it's like the pulse of, understanding the pulse of any kind of a stock. RSI is generally the first indicator which a trader typically learns in his journey towards understanding or trying to master technical analysis. Now, the basic definition of RSI is, of course, relative strength index. To put it very simply, it means basically the change in price momentum. So I'll give you a very simple example. For example, if someone is driving a car and the more the accelerator one presses in terms of pedal, the more is the distance which is covered in a very short span of time. Now, if the accelerator is pressed more harder, which means that the RSI is at a higher level, then the prices can traverse a much longer distance in the same kind of a time span. But if the speed drops significantly, which means that the prices will take a lot of time to try and reach a particular distance. So that's the important parameter or distinguishing factor for RSI. We put it very simply in terms of understanding that it's an indicator to try and analyze the momentum on the market. So on the upside, when the market gets into an uptrend or any kind of an asset class which goes into an uptrend, the momentum has to try and be very similar with the price action. But if the markets are going to a downward trend, that's where we believe that the momentum is on the reverse side, and that's where we tend to exit those positions. Simple parameters to try and understand RSI, which are overbought and oversold conditions. RSI levels above 80 is considered to be overbought conditions. That's where we believe that the froth gets generated on stocks or asset classes, and that's where we tend to advise clients to try and reduce the long positions and be more lighter in terms of stocks. And below 20 is where we see oversold conditions on RSI. Those are phenomenal entry points where someone has a time frame of maybe medium to long term, and someone who buys at sub 20 RSIs has a much higher and a better risk reward than what it is about those 80 levels. So I've explained this with a very simple chart. The chart is on Reliance Industries and I've marked those two important levels. So as you can see that the upper grid is the price patterns over here and the lower grid is the RSI. What I've marked is the two important bands of RSI. So as you can see that the red line which is marked over here is the band for 80 RSI, which means it's an overbought conditions. Now we look at the historical points when the RSI, so look at the point over here where the RSI had come back towards a point of 80. Look at the resultant effect in prices. The prices started to show a top out effect. We go back to just about a couple of years back, 2020, look at the RSI. RSI hit back towards a level of 80 and look at the resultant effect in prices. The prices start to taper off, and this after a steep rally which the prices had already seen earlier. Go back towards the previous levels, this is in 2019, and look at the time when the RSI actually topped out. The prices started to indicate that the momentum and the acceleration is reducing. Now the reverse way to look at is which are the good value points or the entry points for someone who wants to buy the stocks. Then we look at the lower bottom line, which is the 20 RSI. So the blue line which is shown over here, so as you can see when the RSI enters that particular mark of 20, look at the probability of bounce from current levels. And look at the resultant effect in prices. The prices start to stabilize and then we see a gradual recovery at place. Same happened in 2020 correction as well, and we all know what happened in 2020. When the RSI touched that exact line of 20, that turned out to be a phenomenal entry point because the RSI was oversold and the market conditions were deeply oversold. So that's a brilliant time to go contra. So these are very simple tools, but something which helps us analyze and filter the charts in a much more better manner and helps us objectify our decisions in a very critical environment, and environments like what we've seen the last 10-15 days when the markets have gone into a sharp correction. Those are the times when RSIs helps us understand the pulse of the market and helps us stay ahead in terms of the curve.
Kunal, I love the way how you simplified such an important tool for all of us, a relative strength index or RSI as we all know it. What is the margin of error in this one? If we are actually going to gauge it via RSI, what are the chances that you may get it wrong? Is it like a foolproof way of analyzing the markets?
So again, very good question, Cheryl. I would probably look at it this way, that first, one always has to understand RSI and any kind of a price trend on a big macro scale. So we start off analyzing any kind of a chart, whether it's the index, whether it's the stocks or any kind of a different asset class. by looking at the more longer term structure. So we look at the first monthly charts, we look at the setup in terms of RSI, whether the RSI is overbought on long term time scales. If that's the case, then we know that we are at a very precarious kind of a level. And then we look out for trying to trickle this into a short term time frame. The reason why traders make a lot of mistake and try to use RSI in a very different kind of a fashion is they start on a reverse scale. They start off using RSI on an intraday 1 minute, 5 minute chart, and then once they are unable to understand because they get whipsawed in terms of noise, is then when they start looking at the bigger picture that the trend was always against them to try and take a trade. So always remember that the first port of call to try and increase your strike rate and reduce the whipsaws, understand the bigger picture, try and use this indicator on the long-term time scale, start with monthly, go to weekly, daily, and then look out for taking trades and trying to time the trades precisely. That's the first way in which you can try and improve your strike rates and use the indicator to a much better precision. The other way, as you pointed out, that how how much is the noise for the indicator. So this is just plain simple reading of RSI. There are a lot more deeper observations like divergences, which we keep on talking about. Just one example which I would want to put again in terms of divergences. Look at this point over here. So the RSI actually made a top over here. The prices made a relative top over here. Look at the prices going up higher. So the prices made another high, but the RSI actually made a lower high for itself. This is what we call as a topping out formation, a divergence, a bearish divergence, where the RSI is actually hinting us that the prices are moving up higher, but the speed or the acceleration is not as high as what it was in the previous top which was been made. That's a sign where we start becoming cautious and then we start reducing long positions because we know that an inherent correction could be at play. So these are very simple tools of trying to give you a very complex indicator like RSI.